John, one of the interesting things is you guys have been cutting interest rates, but sort of longer-term yields, things like mortgage rates, haven't gone up. Is that a cause of concern for you, and do you understand that dynamic that's happening?
Well, I think it's happening for reasons that are separate from monetary policy. Short-term interest rates have come down. We've seen that, 100 basis points of cuts this year. But other things are happening that are pushing up longer-term yields. I think a big driver of that has been the strength of the U.S. economy. GDP growth has exceeded expectations for this year. I feel, the labor market has done very well. So our economy is doing well, and that has pushed up longer-term yields, along with other factors. So, mortgage rates tend to be tied to longer-term interest rates, like the 10-year Treasury yield. So I think that that's what's driving it. I do expect that over time, as interest rates get back to normal eventually, that we'll see mortgage rates come down. But that's not a forecast of any particular time.
Is it a reason of concern to you? Is it a cause of concern to you that rates are higher while you have been reducing the short-term rate?
Well, we have to take into account all of financial conditions when we think about the transmission of monetary policy to the economy. And I always think about is how is financial conditions affecting maximum employment or employment and inflation. So it's not just what's happening with long-term rates, which is obviously very important, but it's also what's happening with equity prices, real estate prices, and more generally in financial conditions. So it's really looking at the whole constellation of financial conditions of how they're affecting the economy. So I think, yes, longer-term rates have been one of the factors tightening financial conditions, but of course we've seen a big run up in equity prices that's offset that.
John, you are one of the world's experts on the neutral rate. And so I would talk to you for 30 minutes about this if we could, and I would understand about 3 minutes of the conversation. But in any event, could you tell us where you think we are relative to the neutral rate? You have a model that you've created that becomes the basis for thinking about the neutral rate. It really hasn't changed much, but people are saying we may be at the neutral rate now. What's your view on all that?
So I don't think we're at the long-run neutral rate, real interest rate at all. I think we're still in a restrictive stance of policy given where the Fed funds is, where inflation is. So we think about the neutral rate. We tend to think of real interest rates, so adjusted for inflation. My model estimate is that's around 3/4 of a percentage point.
The real rate. So
real
that
rate.
Plus inflation.
So it's 2 3/4% for a long run. Now I should emphasize long run. This is where real rates would be expected to move towards over many years. Now, a lot of people have brought up factors that could be influencing the real rates high or neutral rates higher or lower. My view on that is a lot of the factors that pulled down the neutral rate before the pandemic. We saw neutral rate estimates go from about 2.5% down to about 0.5% before the pandemic. Those are still there. It's really around trends in global productivity growth, in demographics, and other factors. So those trends are still in place. I think the one thing that my head is maybe moving up, the neutral rate a bit is, we're seeing really good productivity growth in the U.S. Productivity trends over the past 5 years have been, significantly above what we saw during the pandemic. So I could see maybe the neutral rate's a little bit higher. Again, my estimate is around the model estimate is around 3/4 of a percentage point, a little bit higher than before the pandemic, but nowhere near where we are today.
So you are still good with your model, add inflation to that, and that means you think you are pretty restrictive at this point.
I do think we're pretty restrictive, but I don't just look at the neutral rate and real interest rates. I look at labor, what's going on in the labor market. You look at job vacancies. You look at quits rate. You look at the unemployment rate. You look at a lot of measures of what's going on in the labor market. Over the past 2.5 years, we've seen a pretty steady cooling of the labor market from very hot labor market to now something that looks something like what we saw in about 2017 or 2018. A good labor market, but not an overheating labor market, not one that's adding inflationary pressure. So I think that's another indicator. The monetary policy has been restrictive, and I think actually continues to be restrictive because that cooling of the labor market is still in train.
So all of that leads me to conclude that you still think there's scope for rates to come down in the coming year.
That's a forecast, or kind of that's what I think. Sure. I do think that we're still. I think the baseline trajectory is moving down towards neutral rates, but we need to be data dependent, and we have time to really assess the data, assess what's happening, and come to the best judgments based on the data, based on the outlook and the risk to achieving our goals. I think we're in a great place, well positioned. Right. We just need to keep doing what we're doing.
I would like to leave it there. Apologies, people in the back room. There's one more thing I have to ask you about, John. As head of the operations at the for the Federal Reserve System, really. You have this responsibility for financial stability. We had a hiccup in the repo market at the end of September. We're coming towards the end of the year, which is a time of pressure in the financial system. How much concern do you have for the turn of the year and whether or not there's ample liquidity to see the financial system through?
I think there's ample liquidity to see the financial system through. I think we will see a little bit more pressures in the repo markets, as we were referring to at the end of the third quarter. We'll probably see that year end. What I'm seeing right now is more of the pattern we saw before we had just super abundant reserves. A little bit more short-term volatility in repo markets. One, it's not spilling into the Fed funds rate. It's not in any way affecting the interest rate that we're targeting at the FOMC. And the second is these are very short-lived. So I feel that we will probably see some pressures, but probably the kind that we saw, say, at the end of the third quarter, or maybe a little bit more. One sign that things are, that kind of gives me some reassurance is clearly market participants, in anticipating some pressures there, have been preparing for that. We're seeing, taking term repo, other things to make sure they're well positioned for the year end and not caught off guard. But we'll watch and see. But again, I feel like we're well positioned in terms of the liquidity and the tools that we have.